Why does the stock market go up one day and down the next? You turn on the news and you hear explanations like inflation, interest rates, earnings, geopolitical events. While a lot of factors certainly matter, there's only one part of the story. The truth is that markets move because millions of buyers and sellers continuously adjust what they're willing to pay for investments. Every price you see is simply the latest agreement between supply and demand. In this video, we're going to break down the biggest forces that move the markets in plain English. Whether you're investing or trading, you'll make informed decisions by avoiding emotional investing. Hey, it's Frank Nagy and welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. Every market operates on one simple principle: supply and demand. More investors want to buy than sell, then price rises. When more investors want to sell than buy, price falls. Think of concert tickets. If thousands of people want a limited number of tickets, prices climb. If nobody wants them, prices fall. Stocks work exactly the same way. Every trade requires both a buyer and a seller, and the market simply adjusts the price until the buyers and sellers agree. One of the biggest drivers of stock prices is corporate earnings. Companies exist to generate profits. When businesses earn more money than expected, investors often become more optimistic about future growth. That increased demand pushes the stock price higher. On the other hand, disappointing earnings or weaker forecasts can cause the investors to sell, leading prices to run lower. That's why earnings season produces some of the biggest market moves of the year. Ultimately, investors are buying future cash flows, not just today's profits. This is why Theta Bridge Capital Management applies non-directional market neutral strategies to investment portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investments, approaches grounded in portfolio construction, risk control, and long-term capital growth. Interest rates have tremendous influence on the financial markets. When interest rates are low, borrowing becomes cheaper for consumers and businesses. Companies can expand more easily, consumers spend more, and stocks often benefit. Now, when interest rates rise, borrowing costs increase. Mortgages become more expensive, business loan costs more. Consumers may reduce spending, and at the same time, safer investments like Treasury securities become more attractive, causing some investors to move money out of the stocks. Higher rates don't automatically mean markets will fall, but they often change how investors value the future earnings. Inflation measures how quickly prices are rising throughout the economy. Moderate inflation is generally healthy. However, high inflation creates uncertainty. Businesses face higher labor costs, raw materials become more expensive, consumers have less purchasing power. If inflation remains elevated, central banks may raise interest rates, which can place additional pressure on the stocks. That's why you'll often hear inflation reports making headlines. Markets aren't driven only by facts. They're driven by human emotions. Fear and greed have influenced financial markets for centuries. When the investors become optimistic, confidence grows and buying accelerates. And when uncertainty increases, fear spreads quickly and selling can become emotional. This is why markets sometimes move much more than actual news would seem to justify. Behavioral finance has shown that investors frequently overreact during periods of extreme optimism and extreme pessimism. Learning to recognize these emotional cycles is one of the most valuable investing skills you can develop. Every month, Wall Street closely watches economic reports. These reports include employment numbers, gross domestic product, consumer spending, manufacturing activity, retail sales, housing data, and consumer confidence. Strong economic reports can signal continued business growth. Weak reports may suggest a slowing economic activity. Markets don't simply react to whether there's good news or bad news. They react to whether the results are better or worse than investors expected. Expectations matter just as much as the actual numbers. Financial markets are connected around the world. Wars, natural disasters, political elections, trade disputes, pandemics, supply chain disruptions, and major technological breakthroughs can all influence investor sentiment. Some events create uncertainty, others create opportunity. Markets constantly evaluate how these events may affect future economic growth and corporate profits. Markets naturally move through cycles. Bull markets are periods when prices generally tend higher, while bear markets are the opposite. They start to tend lower. Neither lasts forever. Historically, markets have experienced corrections, recessions, recoveries, and long periods of expansion. Understanding that volatility is normal and can help investors stay disciplined rather than reacting emotionally to short-term movements. One of the biggest mistakes investors make is focusing on daily market moves. The financial media highlights every small fluctuation because it creates headlines, but successful long-term investors often focus on years instead of days. Short-term volatility is unavoidable. Long-term wealth is generally built through patience, diversification, disciplined risk management, and consistent investing. Trying to predict every market move is extremely difficult. Managing risk is often more important than trying to predict direction. Markets rise and fall because of many interacting forces: supply and demand, corporate earnings, interest rates, inflation, economic data, global events, and perhaps most importantly, investor psychology. Understanding these drivers won't allow you to predict every market move, but it can help you become a more informed investor and make decisions based on facts instead of emotions. Hey, to learn more about Theta Bridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.